Hello, everybody, and welcome to our live webinar today, Maximizing Schedule E Deductions as part of our virtual tax school series. Right now, in the middle of tax season, so we appreciate your time. We know that you are extremely busy trying to prepare as many returns as you can for taxpayers that I'm sure have many questions about their tax situation this year. Anthony, you're an enrolled agent, and I know that you still prepare a few returns, and this year has had to be unlike any other year that you've had in recent history with all the different credits and all the different questions that customers are asking. So Schedule E is a topic that we know is definitely top of mind for many of you, and one that will maximize taxpayers' refunds this year. And who better than Mr. Anthony Sampson to cover the topic and share some insights on how to, maximize those types of deductions. But as you say, Anthony, in your presentations, how to do that obviously legally, by the law. So, Anthony, why don't you tell us a little bit about yourself and your credentials? I know you are, of course, a Wolters Kluwer employee, but before that, you were and you continue to be a practicing enrolled agent with years of experience in tax and accounting.
Absolutely, Luis. Thank you so much for having me today and hosting this webinar. I'm hoping this could be value to practitioners during this season. Tax season grind, there's approximately about, 31 or 30 some odd days left for tax season. My name is Anthony. As Luis said, I've got about over 10 years of tax and accounting experience. Actually, next month makes 10 years that my enrolled agent certificate, my license to practice came in the mail. And but I've been in practice now for ever since 2009, working at small firms throughout the metropolitan Atlanta area. I got my degree in accounting, and I currently work as a solution architect at Wolters Kluwer, and that's really someone who's a subject matter expert, someone who spends time. I speak to many practitioners, firms, people in different tax offices every year, pretty much just about every week. Tell them how can they expand and improve their business, how can they improve their tax practice and grow their tax business, and be able to have a less stressful tax season. And I'm hoping that the topics that we cover today is going to allow you to have a less stressful tax season when it comes to working with your clients with Schedule E, right? Now, Schedule E is a very diverse form, right? On the Schedule E, in a 1040, you can have clients that have royalties, right? How many of you ever had a client that was a artist, right? I had one time a client that was a artist. They were a hip hop artist, I should say. And so there's some royalties that were coming in, but our main focus today is going to be on clients with rental income, right? Rental income and deductions. So we're going to recognize how to work with the Schedule E deductions related to rental properties and how to maximize that taxpayer's refund. We got some great examples that we're going to walk you through, and then also maximizing travel costs related to managing real estate. That's going to be amazing. That we're going to talk about, and the big topic, material participation. That's one of the most litigated material participation especially for real estate professionals. One of the most litigated topics, litigated cases. By the actual IRS. So we're going to talk about ways on how to make sure that your client that you're doing providing the right service and right guidance to your clients, so that they do stand before an IRS audit. They can pass that IRS audit and take those deductions. We're going to be using practical examples in our TaxWise solution. So TaxWise is a virtual tax product, a cloud-based tax preparation solution, and we're going to be using some examples using our virtual tax office that's powered by TaxWise Online and Wolters Kluwer. So let's talk about the attributes of a Schedule E client when it comes to rental property. So a client that leases out part of their home and collects rent, right? That's definitely important, right? A client that actually leases out part of their home and collects rent on that. And then also too, you have a client that acquires real estate and leases their property. So you may have a client, and this question comes up a lot. A client may ask, hey, I got my first home. We bought our second home in February, but we didn't get a tenant in there until October or November. Can we actually claim any deductions for that mortgage or real estate tax? And the answer is yes. You have to do a calculation on the personal usage for those first 2 months if you moved out in March or something like that. But yes, absolutely. Once you move out and you have the intent to lease that property out, the client has moved out their primary residence, and they have that intention. Keyword intention. And you know what? And this is actually going to be our word for the demo today, the presentation: intentionality. The tax law is in favor for real estate professionals or for individuals that own real estate when there's some intention behind that. We can't be doing things haphazardly by accident. So there's going to be a lot of planning tips that you're going to be able to provide to your client. I'm hoping that it can create some value and some value for you as a practitioner. You communicate that value to the client. So also clients have a vacation home, right? What about those Airbnbs, things of that nature, right? Vacation home, especially if it's being rented in excess of 14 days, right? So clients that have a vacation home, that also can trigger a scheduling. Maybe you're going to be going out of town or something like that. In fact, I should have thought about it. I should have Airbnb my house when I went on vacation last year. I should have did that and made some money while I was on vacation. Just kidding. But absolutely. So with that being said, so let's kind of move into the tax deductions and depreciation. So I'm going to actually bring up a particular product on the screen here, and I'm going to go ahead and showcase that the product we're going to be using is going to be TaxWise Online. And TaxWise Online, it's a virtual solution. There's no need for it to be installed, or I should say cloud-based or browser-based solution. So there's no need for an actual installation on your computer, which is fantastic. So if you're utilizing a Chromebook or you're using a Mac or something like that, you don't necessarily have to have a Windows computer in order to use this product. And we're going to be using our examples today are going to be inside the actual TaxWise solution. So let's look at here, Lisa. So Lisa rents, right? So we're going to be using Lisa as an example. Lisa lives on 123 Main Street and everything. That's exactly where Lisa lives at. And then you'll notice right over here, so we've got her title as real estate investor. So we're trying to use that title to help that, hoping that will score some points with the IRS. Not necessarily, but we're putting that title down here, right? That doesn't really make a big difference. But we're putting directly in here some, we've answered some things about Lisa. She's single. Her filing status is single. And she doesn't have any kids, so there's no advanced child tax credit or anything like that. She's very conservative. She doesn't have any virtual currency or anything like that. So what we're looking at right now is what's called the main information worksheet inside of TaxWise. That's what we're looking at directly right now. Now, as we scoot further down in here, you can see that Lisa lives in the state of Georgia. We're going to be e-filing. Now, we can see right now that we have Lisa. She has a W-2. And Lisa, on her W-2, Lisa, she has a pretty good salary, right? She made about $75,000 a year. But unfortunately, Lisa, she did have only about $7,000 of taxes withheld from her actual W-2. Now, Lisa does own a rental property. So let's kind of take a look at this. I'm going to go add that in here. And let's put in here Schedule E. Right, she does own a rental property. I'm going to walk through the process of building out this rental property and what's tax deductible. So she didn't pay anyone that requires a 1099, but let's scoot further down over here so we can see examples. So let's say Lisa, her property is on 227 Street, right? I'm dating myself. Does anyone know about 227 Street? I'm dating myself right there. So Lisa's property is on 227 Street, and she has a single family residence there, right? And she rented it out for all of 2000. The fair rental days was all 365 days of 2021, right? So let's just say hypothetically for this case scenario. So the way how it works in TaxWise is we actually have worksheets behind here that support these numbers, right? So let's talk about some of the deductions that can be taken: advertising, auto and travel, cleaning, commission. Now I want to hone in a little bit on this auto and travel. This is very important. Okay, so I'm going to click over here. I'm going to show you how I'm going to get to this worksheet over here. There's this worksheet that supports all these numbers in TaxWise. And when I click over here, it's called the rental worksheet, right? And what the rental worksheet does, it really simplifies the process. So let's say hypothetically that the client didn't rent out all of their home, or maybe the client lives in a duplex and they're renting out the first floor and they live upstairs or something like that. TaxWise can allow you to, it will allow you to put that percentage of time that the property is rented, and it will calculate what that exactly is. So let's go ahead and put 227 Street on my worksheet over here. And it's going to be a single family home, and so this is the worksheet that calculates that information. So what percentage of it is her time devoted to this? What percentage of the property is for rental? 100%. Let's say 100% for this example. So now if let's say we had 50%, if it was 50%, right, then what would happen is when I start putting in some of these expenses like cleaning and maintenance, let's say we had $1,500 in cleaning and maintenance, TaxWise would automatically put that half over there. So it makes it easy from a preparation perspective. You can see, so if the client, perfect example, with that duplex, things of that nature, let's say the client has some actual mortgage interest, things of that nature, it would automatically split that over based off the percentage of the time the property was being rented out. So if you lived in that property January, February, moved out on February 28th, and then it was designated for rental, then you'll calculate what that percentage is. All right. We're going to go ahead for this example. We're going to go ahead and put 100% of the time was rented out. Now let's kind of walk this here, right? Now, one of the things I want to stop, I really want to bring this to emphasis. Now, as a practitioner, when you're working with clients and clients give you the rental, the expense, what's the most important? What's the most thing they probably give you? They give you the property taxes, they give you the mortgage interest, right? So say, for instance, that Lisa collected $10,000 in rent, and typically, the clients complain, oh, he or she didn't pay all the rent, he's a scumbag and stuff like that. You'll hear that kind of stuff, just joking. But the point of it is that you'll go ahead and enter any expenses that the client had related to running the actual property. Now, one thing that I want to make sure that I bring to reference right over here is the fact that the client does not provide you any auto and travel expenses. I want you to stop the entire interview at that exact moment. Put the brakes on everything, stop. So if the client does not provide you any auto and travel expenses, you got to stop for a second and ask that client, are you sure? They say, no, I didn't have any auto travel expenses. But let's think about it for a second. Let's pause for a second. So let me go ahead and skip a slide right here, and I'm going to show this slide to you. In 2022, 2022 is 58.5 cents per mile is a deduction for transportation, right? However, in the 2021, it's about 56 cents per mile. Now let's talk about this for a second. So let's come back over here to TaxWise. You mean to tell me the client never went to Home Depot or the hardware store to buy any things for repairs? You mean the client didn't go and drive and see their rental property, right? Things of that nature if it's not located in a certain area. So in most cases, when a client will have auto and travel expenses associated with running that actual property. Okay, so I want to make sure that I just bring great emphasis to that. The client will have these type of expenses, so you really do want to spend time with that. So there's a couple ways you can do it. You can go direct and pretty much just take the calculator and do that, or we've got some tools in TaxWise to show you that, and we'll go that a little bit more detail a bit later on in the webinar. But I just want to make sure that you are spending time with the clients, getting understanding of that mileage, how many times did you drive, just like how you do for somebody with a Schedule C, using your truck for business and things of that nature, or your vehicle. The client is using their vehicle, maybe to go look at properties, right? So I'm going to put some expenses in over here. I'm going to intentionally do that. Let's say they have some insurance expenses, things of that nature, of about $1,500. Let's say they got some property management fees, so that's 10% of the actual gross receipts that came in, or rent that came in. So we've got that. We've got the mortgage interest. Let's say for mortgage interest, we had approximately for those mortgage interest, say we had approximately $5,000 for mortgage interest. Repairs, right? We had some other repairs that we may have had. So let's say for those repairs, we had maybe about $3,000, right? So we're adding this all up and we're working through this. So right now we got about $14,000 in expenses that we've got over here on the Schedule A. Now I've been in practice now for over 10 years. And typically when I do a client's return, the client comes in and they give me their prior year taxes. And one of the first things I look for whenever a client has rental property, the first thing I look for whenever I'm viewing a prior year return, we're looking to see, was the depreciation deduction taken? It's the first thing I'm looking for, because this is a deduction that you're getting, a non-cash depreciation deduction, right? That you're getting that's stretched over a period of time. So I'm going to walk you through this example of depreciation in TaxWise, and there's a reason why I'm going to do this for you. I mean, many of you practitioners are seasoned, you know exactly what depreciation is, but there's certain rules and certain things about the depreciation first. I'm going to go ahead and put this on here, and let's say this is for 227 Street, right? That's our property, 227 Street. And we've got our depreciation worksheet that's located right over here. So asset depreciation worksheet in TaxWise. And we're going to go ahead and say, okay, this is for a residential rental, right? We've got that listed over there, residential rental. And then we have our listing. So we have a depreciation manager inside of TaxWise Online. Even though this is a browser-based solution, it works in your web browser, we do have a depreciation manager in here. So for real property, residential, now the good thing, now non-residential commercial property, that's 39-year depreciation. Residential is 27.5 years. So you're gonna be able to take that depreciation deduction for 27.5 years. Now I'm gonna go ahead and put the date. Let's just use 2021. Let's keep it simple, right? Let's keep it simple. So let's say the property was placed in service service on 02/15/2021. All right, there's 227 Street. All right, we've got that listed there. Is this property a real estate, a residential real estate? Yes. Now, here's the common mistake that I see practitioners make, right? And I want to walk you through this. I've got an example. Here is my example. Let's try to find Anthony's example. So here's an example over here of a client that has the property tax bill. All right, so it's a property tax bill, and let's just say, for instance, the property is 202,500 is what the assessed value is on this piece of property, right? I would see clients go in there and say, okay, hey, Lisa, okay, how much you paid for the property? Oh yeah, I paid 202,500 for the property. Okay, yep, I remember. I paid 202,500 for the property. Right now, TaxWise is going to calculate the actual depreciation deduction. So TaxWise is telling us, okay, automatically 27.5 years. TaxWise calculated mid-month convention because based off depreciation rules, mid-month convention is what's used. Now, the deduction for the depreciation is $6,444. And this is what's fantastic about it because the client is getting a depreciation deduction and TaxWise is also calculating what next year's depreciation deduction is of $7,363. Now, did we do this right? Client said they paid 202,500, right? We've entered that in here. We're depreciating it. Let's take a good look at this again. Oftentimes, sometimes I see practitioners would start depreciating it, but they would not subtract the value of land. Land is not a depreciable asset, right? So we need to remove the land from the base and the base of the assets being depreciated. We need to remove that from the real property. So looking right over here, so really and truly, I need to just put 200,000. Right, remove that land, and you can get the land value from the real estate. I mean, you can use that land value from the real estate, the tax assessor's office. But if you are audited by the IRS can challenge you on that land value. They can. I'm not saying that they're going to do it all the time, but there can be a challenge associated. There's another place where you would put the land that in TaxWise towards the bottom of this worksheet. You'll see right here if the property is sold, sale of non-depreciable business asset, and a non-depreciable business asset would be the land. All right, so we've removed the land from the basis. Now the property is being depreciated. Now, here's another mistake I make, and I'll give this practical example. I've got a good friend of mine, and even the way I grew up, in our basement. I grew up in New York City, and we rented out our basement to people, and we had furnished the basement. So it had bed, it had all that kind of stuff, just like how you go on modern day Craigslist and stuff like that. Got a friend of mine, same thing. He just bought a property out here in not too far outside of Atlanta, and he's furnishing it out and he's renting rooms out in the entire house. So it's like a 4-bedroom house, and he even made a 5th room. And what I would see is he would say, okay, you bought the house, $200,000. Okay, we're going to depreciate it. What about the furniture, the bed, right? What about the furniture? Just because for depreciable, the real property is depreciated at 27.5 years. But what we need to do is we need to come over here and we need to add another 4562, and we need to extract the furniture from that. We need to go ahead and I think I added 2 4562s. Yeah, I did. I added 2 4562s. That's all right. Let me delete that one. Very simple. As you can see, practical example of TaxWise. Very simple to remove these things. So we're going to go back and put this with 227 Street. All right, we're going to go back and put this over here, and then for accurate computation, we're going to go back to our depreciation worksheet. So on our depreciation worksheet, we're adding a new asset in here, but now this asset is going to be furniture, right? And how are we figuring out? So we're going to come right over here and directly, and TaxWise is going to help us in this process. So I can just come over here and start typing furniture and fixtures. I can start typing that in there and put that in there. Disregard that. Date, place, and service. Let's say we bought that on 03. We bought the property on February 15th, and we're going to start depreciating. We bought the furniture on 03, 01, 2021, right? It belongs to 227 Street. All right, and what's the base? So we bought furniture for the entire place. So we bought some beds, we bought some bedside tables, all these kind of things that we purchased. Maybe we purchased a toilet, we purchased. So let's see, some of these things qualify for Section 179. Bonus depreciation, things in it. Don't just take the client's entire rental property and just start depreciating in 27.5 years. Let's maximize the actual deduction. So what's the cost base? Let's just say they spent $5,000. $5,000 on furniture and stuff like that. So we can actually take 179 depreciation if we wanted to. We definitely can go ahead and do that. If we wanted to, we can do bonus depreciation. There's things that we can do to customize these deductions. If we want to take the special allowances for the depreciation, there's a lot that we can actually do, but we just applied the $5,000 to it. We just applied that. So there's so much creativity. That we can actually do from a depreciation perspective to take 179. I think I unchecked the wrong box over there. But there's so much things that we can actually do from a depreciation perspective, okay? So I just want to let you know, take into consideration the client's actual depreciable basis in the furniture, the fixtures, the refrigerator, some of those other things that you get inside the property. Don't just start depreciating the client's property at 27.5 years. So I want to make sure I just bring that to your attention. Now, as we're continuing on in this, let's kind of come back to this example over here. So let's look at this Schedule E. So we're looking at this Schedule E, right? And we can see over here that we've got the rent received at $10,000. We can see the expenses. And altogether on this, we can see that this has an actual loss of $11,614. There's a loss on this. And we're going to talk a little bit more about the losses. But before we kind of get into the loss here, because remember now, Lisa makes $75,000 a year. With her W-2 right now, she owes $2,524, right? How could we get some of these losses? But we haven't finished all the deductions because Lisa did some traveling last year, right? And what kind of traveling did Lisa do last year? Lisa went to a real estate conference last year, right? Lisa's from California, and she went to a real estate conference. She went to go see her mom and her dad and her sister, but she went to a real estate conference last year. What should Lisa do in order to allow that going to that real estate conference to be deductible and that trip to go seeing her mom? What should she actually do in this case scenario? So I want to introduce you to a topic, a method known as what's called the weekend sandwich. So the weekend sandwich is where the IRS is where you create, where you're traveling is around a business intention, a business purpose. So there's a conference that's taking place, a real estate conference that's taking place in Los Angeles, California. And so Lisa lives in Atlanta, so she has to fly all the way from Atlanta, right? 5-hour flight, fly all the way from Atlanta to the real estate conference. So what's her primary purpose? Her primary purpose is to attend the actual conference, right? That's her primary purpose. Now, she wants to go see her mom, her dad, her sisters, some of her family because she's from Los Angeles. So she wants to have some leisure time in there. Well, you're allowed to have a travel day. She has a conference, she attends a conference, so it's primary purpose. So because of this, her entire flight is deductible. Her meals on that day is deductible, right? And then you've got her leisure, that's on Saturday. So the conference is on Friday, leisure's on Saturday. I'm seeing mom and dad. I'm also gonna go to Rodeo Drive, go shopping, have some fun, or at least it's gonna do that. And then you know what Lisa's gonna do? Lisa's actually gonna meet with a real estate professional. Maybe Lisa's looking at purchasing properties in California and say, hey, you know what? I think I want to have a property in LA or something like that, or I want to do a flip in LA. So she's going to meet with that. She's also going to spend that Monday meeting with tax advisors. A tax advisor, it's a famous known tax advisor in the Torrance, LA, Los Angeles area. So she's going to go meet with that tax advisor. She's meeting with some real estate professionals to get an understanding of the environment. And then she's also meeting with a famous tax advisor in the Los Angeles area. So she's doing that on Monday. And then on Tuesday, she's traveling back to Atlanta. She's catching a red eye Monday night or flying back to Atlanta. So the question is all of that travel tax deductible, right? Can that be tax deductible? That's the question. And I want to kind of talk a little bit more about this. If the primary purpose of the travel is a business travel related, right? So the primary purpose, so you just can't go flying and booking flights and say, okay, hey, I'm going to Hawaii, I'm going to California, I'm going to do that. No. Documentation, so emailing the tax advisor she's going to be meeting with, emailing the real estate professional, purchasing the tickets to the conference, the real estate conference, right? So the intent, you have the primary purpose of the travel is business related, right? And the benefit is the meals are deductible up to 100%, right? I'm going to double check that for 2022, but I believe for 2022 meals are tax deductible, right? For 2021 they are 100% tax deductible, not the 50% limitation. We're going to definitely do a check on that, but definitely for 2022. So, right, so clients are required to keep records, receipts, documentation, support the travel, support the mails, keep all that in an actual file. Okay, definitely keep all that in the file. And one last question, one other thing too, I want to go ahead and explain to you. Let me kind of bring this up on the screen here. I'm going to bring one more thing up on the screen here. I've got a friend of mine, and a friend of mine, he actually has property in South Georgia. He lives in Atlanta, and he has a property on the southern tip of Georgia, right? So I said, man, that's amazing. That's a really good, amazing thing. So let's look at this. So he lives in Atlanta, Georgia. And so I said, okay, so lives in Atlanta, Georgia, and he is going to Orlando, Florida for vacation, right? So he's going to Orlando, Florida. So his trip, so his property is located right over here in the middle point, right? Do you understand that half of his travel, if he's sending out emails, so he has over 10 properties in the midpoint right here at the borderline of Georgia. So you understand that half of his travel, if he sends out his emails and his documentation to his property manager. So he said, okay, we're going to travel down there. I'm going to send the emails to my property manager, say, hey, we're going to schedule a meeting. And when we schedule that meeting, we've got all of this trip that's tax deductible. And on his way back, schedule a meeting, look at properties, look at, meet with his property managers, meet with his real estate brokers. So that's where you're using the actual auto and travel as a tax deduction. Do you understand what I'm saying? So when you're working with clients with real estate, you want to be strategic, and you want to tell the client strategically, I think this is the place where you should actually purchase your property at. This is definitely the place where you should purchase your property at. So let's say, for instance, I'm going to go ahead and I'm just going to add another depreciable asset on here. And that's why when you're doing clients tax returns, you got about, some of you folks got about 30 more days, right? You got about 30 more days for your tax season to come to an end. You want to sit down and talk with that client and get an understanding of their travel expenses for that 58 and a half cents per mile for 2022, but also for 2021. So let's just say your friend has his nice F-150 and it's an automobile, right? So we got the auto check. Sorry about that. We got the automobile check, and then the vehicles placed in service, sales placed in service on 02/15/2021, and we've got that over there. All right, and then we're gonna tie that to 227 Street for the deduction purposes. And we can take, there's a depreciation component that you can take for the vehicle. I mean, you can, if they paid, let's say they paid $36,000 for that F-150, there's a depreciation component. But let's say this vehicle is not being 100% used for business. Let's say the vehicle is not being 100% used for business. So we do have the ability to calculate the mileage portion of it. So the mileage portion of it. So let's say, going back to my client over here, with his trip, well, not my client, my friend, yeah, I've never done his tax. I want to keep our friendship. But going all the way down here, let's say half of this trip is going to be from a business perspective, right? So we're talking about at least 228 miles, because he's leaving his house in Atlanta and going down over here on his way to Disney World with his family, but stopping and meeting with his real estate agent, his property manager, and things of that nature. So coming over here, let's just say that let's just say that he took a couple trips down to Disney. He also looks at properties in the Atlanta area, things of that nature. So let's just say all in all, we've got about 3,770 miles, right? And then we've got some communicant miles and things of that nature, but it's not used 100% for business. So let's say, since it's not used for 100% for business, let's say all in all, he had about 10,000 miles, right? So we don't have a full business usage, but we still have 3,770 miles. We still do have that, right? So if we take into consideration, now let's say this for 2021, you've got the 3,770 miles, 3,770 times 0.56. So that's $2,111 for auto expense, right? And do you see, so when you're sitting down with clients, you really want to be strategic in how you're advising and guiding that client. So if I came back over here to my actual rental A worksheet, and my auto expense deduction over here, and you're going to see how TaxWise is going to calculate this for you. My auto expense deduction is going to be 2,100. And you can have support, like I can put a worksheet right here, and I'll show you in TaxWise, we can use and put a worksheet over here. We call this scratch pad. So we can say for our worksheet right over here, we can say auto mileage, right? And I could definitely put 0.556, I can't get it right today over here, 56 cents a mile, right? And then we can go ahead and put our deduction in over there. I think it was times 3,770 miles. So altogether, our deduction was $2,111. So $2,111, right? So we've got that. So that's going to flow back over because we use our scratch pad. That's going to flow back over to our rental A worksheet. And looking at this right now, so we've got our rental A worksheet. Altogether, we've got a significant amount of expenses. We got a lot of expenses, $30,925 in expenses. We got a lot of expenses over here. Let me take a look at my depreciation. We got a lot of expenses going on here. Now, let's take this in consideration, right? We've got one property. Now, if the client had multiple properties, we'll have multiple Schedule E worksheets and things of that nature, but we got a significant amount of deductions that we've got over here. Now, here is where I want to launch our next polling question, Luis. And we're going to get into a very hot topic. It's called material participation. This is very, very important for tax advisors to be very familiar with this. And I'm going to walk you through how you go through material participation in TaxWise. All right. But let's say hypothetically that I am renting out part of my home, but I'm going to Home Depot to buy a toilet. I am going to the bank to deposit rent deposits that they gave me, right, to pay the mortgage. I'm just doing general activities. Well, that trip to Home Depot to buy the toilet, that trip, to a Lowe's, that trip to the bank to make the bank deposits from the rent, maybe the client, gave you the rent and then you took it to the bank and deposited it, right? That's a business expense. Driving to the bank to deposit rent, driving to Home Depot and Lowe's, that's a business expense. Guess what? That's 50 and a half cents per mile to Home Depot. If I was you, I would go to I'm just kidding. Don't go to your neighborhood Home Depot, just kidding. But let's talk about something important when it comes to material participation, because we want to go back to Lisa's example over here. Lisa has over $30,000 in expenses. She only collected $10,000 in rent. Right, so Lisa lost some money, right? She's making $75,000 a year. Right now, she owes the IRS. How can some of these losses, right, from this activity offset and help her out? I want to talk about this. Is one of the most litigated topics, and we're not going to go into such full detail on it today on this webinar. We're going to just go through some practical examples in TaxWise and how to work through this. But when you have material participation, right, there's so many rules around this, right? We're going to take one of those rules around. We're going to talk about material participation and rental losses. So if the rental losses, there's an allowance, a $25,000 rental loss allowance the IRS does allow you to have if a rental real estate activity which owns at least, what they own 10% of passive income does not have any carryovers, right? So if there's no carryovers, right? So if you own at least 10% and you are only passive activities and you don't have any carryovers, you may deduct losses up to $25,000. 12,500 married found separately, and now your modified adjusted gross income cannot exceed. When your modified adjusted gross income exceeds $100,000, it begins to phase out. Right, it begins to phase out up to 150,000, and I'll show you. And I'll show you an example in TaxWise. So, for instance, what does it mean to actively participate? Oh my goodness, there's so much content on this. So, in these case scenarios, when we're working with clients, because what is Wolters Kluwer known for? Luis, what is Wolters Kluwer known for? When you have to be right. That's exactly what Wolters Kluwer is known for. So there's a product that Wolters Kluwer created. It's called CCH Answer Connect. And Answer Connect is a professional tax research solution. It works in your web browser, no software installation required. But this allows you to do the necessary research that you need. It has the full entire master tax guide. It has the internal revenue code in here, the regs, explanations, cases, pubs, you name it, we've got it in here when it comes to all things taxation wise. So I did some research in Answer Connect before our presentation, and I wanted to get a definition. How does the IRS view material participation? So you've got there's a 7 test rule, and you just got to meet one of these, right? So Lisa just needs to satisfy one of these. If she participates, that in the real estate property of over 500 hours during the tax year, there's other things that can help her meet it, but we've got our 7 tests here. So this is very important that you as a practitioner, right? You're not Googling this, right? How many of you went to the doctor in the last 2 years, right? And you go to the doctor and you said, I know me, I went to the doctor and I said, hey, I think I have COVID symptoms. Then a doctor start Googling what COVID symptoms are. Let's see, Anthony, well, based off Google, Google says that, yep, if you lost taste, you have COVID, Anthony. Yep, you got, no. They've got professional tools they're using. They gave me a test. They did their analysis, their research, the things they did that before they said, Anthony, yes, you do have COVID. Here's what you need to do. You are a tax professional, right? Professional solutions are what you need to be using. Just like how you're using TaxWise to prepare the return, using a product like CCH Answer Connect is effective, where you can start typing material participation, and as I'm typing it, you're literally seeing the answers populate for you right before your eyes. So looking over here, material participation is defined in section 469H. I didn't even know that, right? And turn over to go section 469H until I did the research, and I didn't turn through thousands of pages right here in the digital format. Our CEO, Nancy McKinstry, made sure that our business transitioned over to being a digital information company, and all of our content, or most of our content, is now digital when it comes to tax research. So you're seeing right over here that this is what defines material participation. So Miss Lisa over here, let's say she meets the 500-hour test. She spends time with her tenant, she works on the property, or she has a property management company, she works with that, she spends time with being involved in the active participation in the property. So let's go back to Lisa's example. So because of that, I'm going to come over here to the Schedule E section for just a second. And on that Schedule E section, you'll see right over here that Lisa, since she materially participates, she has this loss, right? She has a loss right here of $20,000. Since she materially participates, we'll say, yes, look what happens to Lisa. Lisa's getting a tax refund, right? If Lisa doesn't materially participate, Lisa owes $2,524 to the IRS. But by Lisa materially participating in the real estate and in the property, then now she's getting a refund of $2,116. Okay, and there's more to it, right? There's definitely way more to it. Now Lisa's loss is limited up to $25,000 per year. Of special rules associated with that. If Lisa was a real estate professional, her losses can be unlimited, so her losses can reduce that. So I'm going to show you one slide about that, and then we're going to go ahead and wrap up because we're coming close to the end of the presentation here, coming close to time here. And one thing I want to say, how many folks are married? Anyone married? How many people in here are married today? Right. So I'm going to use this example here for the married individuals. Let's say George. George is a full-time CPA and he's making $300,000 a year, right? And he owns 8 rental properties, right? But George's wife is a stay-at-home mom, right? She takes care of the kids, but she also helps manage the properties, right? She also helps manage the property. So since she also helps manage the property, she has a total of 800 hours. So there's some special rules along being a real estate professional where you can offset more of your losses, right? So let's think about this. So combine all the rental property losses are $70,000 for the year. So I've got this information right over here. So I got this information on CCH CPE link, but I want to show you something. George makes $300,000 a year. His wife, Lisa, she makes, she actually manages the properties. The properties have a loss of $70,000. Just curious, put in the chat box, what's Lisa's income, George, his spouse's income? Does his spouse have any income? Just put that in the chat box. Anybody, just put in the chat. Do you think his spouse has any income? Do you think that his spouse has any income? She's a stay-at-home mom. She manages the properties. The properties have a loss of $70,000. Well, what's happening here in this case scenario is that $70,000 loss qualifies her because she meets 2 tests. She is actively involved in managing the property. More than half of her personal services time is devoted to managing the real estate, and she performed more than 750 hours of service during the year. So since she's done that, that $70,000 loss can offset George's $300,000 income. So for all you folks that are married, what does that mean? It means that she has technically a $70,000 income because she can offset that $300,000 of income that George makes only because she has the time and she meets the material participation test. She does meet that. So I wanted to make sure I bring that to your attention. So you want, now if we were in TaxWise, you would click this button over here that they're a real estate professional, and then more of the losses can offset, and you're not going to be capped at $25,000. But that's why it's so important to use products like TaxWise, Answer Connect. Then we've got another product called CCH CPE Link in our virtual tax office. So using tools like this in your web browser, this is how I'm getting this content, to create this content to be able to present it to you and have a fairly good understanding. So let's launch our last polling question here. And if you want to learn more about TaxWise Online and the virtual tax office solutions that we use, please go ahead and respond to that chat box, because, and like I said, it's tax season. But I encourage you, maybe you want to use TaxWise after tax season. Maybe you're going to file, 150 or 75 extensions this year, and you say, you know what, I want to try a different product. I want to try a browser-based solution. I want to try a product that is equipped and engaged and integrates with tax research. I want to be able to access the same content that Anthony was able to access and maximize the client's refund. I want to do that because maybe I'm not getting that with my current provider. So definitely we can send you some information about that if you'd like to speak with a solution consultant. But TaxWise is a live running solution. It does enable your tax office to be able to take those deductions, and you're not having to push a calc button, but also having the integration with Answer Connect, having the integration with our CCH CPE link, and then those tools we had to be able to maximize the client's tax refund when it comes to material participation and things of that nature. So definitely we can have somebody reach out to you. Luis, is there anything that you want to add as we come to a conclusion here on our Maximize Schedule E webinar today?
No, I think, Anthony, first of all, thank you once again for a wonderful webinar. I know a lot of preparation went into coming up with the content and ensuring that it was on target and relevant for tax professionals. So first of all, thank you for that. And I think you covered it all. As it relates to TaxWise Online, we have seen how a lot of tax professionals are taking advantage of virtual tax office solutions, essentially cloud-based, browser-based. All of it is the same. What you're doing is you're accessing, as you said, your tax office from anywhere at any time, and flexibility is key when you're looking at maximizing your revenues as well. So I encourage you to take a look at TaxWise Online. There is a link here where you can watch a 15-minute overview by Anthony as well. And if you selected that, you would like more information, we'll be sure to send you more information via email or to give you a call. But definitely worth taking a look. But if you're ready to make the switch now, we can set you up in less than 24 hours. So Anthony, once again, thank you for attending presentation today to everybody. Thank you, Anthony, for putting it together. We'll stay here over the next couple of minutes in the Q&A, answering any questions. And we'll hope to see you again on the next one. Bye-bye, everybody.